Good morning, guys. Matt from Blaze Capital here. So last week we went over why ETFs are better than mutual funds and how passive investing works, all that kind of stuff. So disclaimer, I'm not a financial advisor or anything, so make sure you talk to a fee-only financial advisor before doing any investment decisions. You don't want to just walk into the bank because they're just going to tell you to buy the junky mutual funds that we talked about last time, where they get 3% commission, make tons of money off you, and then you get to keep none. So fee-only financial advisors will charge you whatever, like $200 to $500, some $1,000 an hour, and then they'll give you a full laid-out plan, help you through it, all that kind of stuff. So today we're going to go over like asset allocation and just some kind of different rules of thumbs, different options for people, and you can figure out which option you think is best for you, and hopefully talk to a financial advisor, and you'll be a little bit more prepared and with some questions to ask and that kind of thing. So the main theory behind all this stuff is just keeping it really simple. A lot of you guys don't have all day to sit and look at the stock market and like check over your portfolio all the time and stuff like that. And a lot of those active funds don't actually end up outperforming the market anyways. So the best way to do this is called dollar cost averaging, where you add a certain amount each month or every 2 weeks, like whatever you're comfortable with, and that's going to be all dependent on each person, how much they're able to save. And then you can play around with that compound calculator that we went over last week, and then that'll give you a little bit easier way to plan for like retirement, that kind of thing. You can figure out how much money you need, all that kind of fun stuff. So a couple rules of thumbs. In general, people will do their age in bond percentage out of 100. So say I'm 30 years old, I'm going to have 30% of my portfolio in bonds and then 70% in equities. And then you're going to rebalance those like annually or whatever at the end of the year or something, whatever makes sense. So that way, the reason for this is when equities are doing really well, you're going to sell some of those and buy bonds, and which will help hedge your portfolio a little bit. And then when equities are doing really bad, you can take money out of the bonds and then buy kind of the bottom of the market. So this is the S&P. The index won't work on TradingView, but it goes like way back to like 1930. So in general, though, the market is always trending up and to the right. You're going to have some pullbacks here. So I'm going to switch over to the bond comparison here. So this is the bond compared to the S&P. So as you can see, the bonds stayed relatively stable, and you're going to collect fixed income off these, whether they're all going to be different, like 1%, 2%, 3%, whatever the interest rate is at the time. So when the market crashed in 2008, if you had a percentage in bonds, you would be buying the equities up here. And then, so right now the market's doing pretty well here. So we would be buying some bonds here. So when this comes back down, you're going to be able to buy some cheaper equities, and then that's going to increase your overall returns. So that's the reason why we keep bonds in our portfolio. The other thing is kind of like your risk level. So everyone's going to have a different risk tolerance. There's some like kind of questionnaires you can do online that'll kind of tell you what your risk tolerance is. So there's a few different kinds of risks. There's the risk of like your portfolio dropping. So here, for example, if you were very high in equities, you would have took a pretty nice 50% haircut there. But there's also the risk of like missing out on returns. So you kind of have to like weigh the differences, and it's all going to be like depending on your age, how far away you are from retirement, if you have a big purchase coming up, all that kind of thing. And then you're going to want to do, like for kids, we have RESPs in Canada. Like you're going to probably do those because those are a shorter time frame as opposed to some of the longer ones. So all of those are going to come into play, and you should probably talk to a qualified financial advisor to figure out like your direct allocations, whereas these are just kind of rules of thumbs to go over. Okay, so one other thing we can mention in Canada is Canada has we have something called GICs. There's something in the US as well. I'm not familiar enough with them to comment. So this website here is Rate Hub, and you can compare different rates from different banks, that kind of thing. So what a GIC is, it's a government investment certificate, and they're covered up to, I believe, $100,000, but don't quote me on that. These are much lower risk, and they give you a fixed return. However, if you redeem those early, that you're going to get charged a penalty. So this would be money that you want to lock up for a set period, and there's complicated ways to do like GIC ladders and that kind of stuff, but I'm not going to get into too much of that. I'm just kind of showing you guys some options. Okay, so we are going to talk briefly about like some ETFs to purchase. So in the US, so our asset allocation is going to come down to a part in US, part international, part bonds, or strictly US, or if you're in Canada, it'll be Canada, US, international. And all this stuff is going to, again, change on your personal situation. So we're just going to go over a few different combinations that you guys can look into. So Warren Buffett, like I talked about last time, he is a big fan of just buying the S&P 500 and nothing else, which is pretty easy, right? The reason being is that a lot of the S&P companies are they're very diversified, and they have a very wide reach. So a lot of them they'll be in Europe, they'll be in Asia, they'll be in South America. They'll have some sort of distribution or influence on all those different parts. So that's kind of what his theory behind what he does is, which again, like, there's not going to be a right or wrong answer. It's all going to come down to your personal situation. Okay, so for 100% equity, we would buy VOO, which is the Vanguard S&P 500. So I can just pull these up quick. So Vanguard S&P 500 index. This one has a management fee of 0.03, which it's pretty much nothing. So you're going to get charged almost nothing to buy this index fund. The next allocation would be international mixed with US. So the two funds for that is VTI would be total market US index, which they're pretty much matches the S&P. You can look at all the holdings. This one, they just hold a lot of stocks, so keeps everything really diversified. And then the other fund would be VXUS, which is the rest of the world except for America. And those have a combined fee of 0.06. Then in Canada, a lot of my Canadian information will be based off Dan Bartolotti's couch potato portfolio. So his theory is the same. He uses 3 separate funds, which we'll go over, and you just rebalance those as they get out of line. So the 2 for that would be VCN, which is the Vanguard TSX, I think. Yeah, Vanguard TSX here, and then the XAW, which is Vanguard except for Canada, so it's the rest of the world. I'm not sure how much I fully agree with even having Canadian exposure. So this is the TSX down here, and this is the S&P 500 up here. So the S&P 500 has returned over 100% more than the TSX since 2011. So, that's a massive discrepancy. So you're basically losing out 100% by having Canadian, having a percentage of your portfolio in Canada. So the solution to that would be buying what's called a world fund, which would just make up the whole world. US, and then Canada will be a part of it. And I think it's XWD is the ticker for that one. Yeah, so XWD holds all the stocks in the world in certain ratios, which is pretty awesome. It's also got a really low management fee, so that's another option there. And as you can see, the performance of XWD was like not as underperforming compared to the TSX. So these are just different options. So we're gonna run through like some of these different options for people. So the first one, it's gonna kind of go from like easiest to most difficult. So first thing we're going to go over is a company called Wealthsimple in Canada. I'm sure you guys have something like that in the US. So what it's a RoboAdvisor. So I typed in my personal information, stuff like that. It maybe took me 5 minutes. So this is going to calculate your risk tolerance and everything like that. And again, like this is a pretty good tool in general. So if you could just run through this and then just calculate kind of what your risk tolerance is, and then you could go based off of this. So with this is Wealthsimple, what they generated for me. It is my asset allocation and based on my risk tolerance. I'm pretty high risk, I'm pretty young still, so this will change depending on how old you are, what kind of drop in equity you can handle, that kind of thing. So this was my plan here. It lets you put in how much you can contribute each month, etc. So it spit out this nice list here. So S&P TSX Composite, VTI, which we just talked about. This one's Europe, bonds, US Total Market Index, and then emerging markets, and then more bonds here. So these are all really low fee funds as well. They're really good actually about this. So most of these funds are going to be less than we'll say decimal 3% management fee. And then Wealthsimple charges you in between 0.5 and 0.3 depending on how much, how big your portfolio is. So this is a really good option for somebody who really doesn't want to do too much. You can set up automatic plans and all that kind of stuff with Wealthsimple as well. So you can send them whatever, $100 a week, $200 a week, etc. And then they help you purchase your ETFs and everything. So this one's just like a nice, easy option for people. The next one we're going to go over is the Canadian Couch Potato Fund. So this one was designed by, I believe, Dan Bartolotti and his team at PWL Capital. They're also fee-only advisors in Canada. Again, in the US, you guys are going to have to figure something else out. So they have 3 funds that they purchase or recommend purchasing. So this is kind of the, this would be your risk tolerance here. So there's the BMO Bond Fund, Vanguard TSX Fund, and then XAW, which we talked about earlier. So this is going to hold all the stocks except for Canada. And then your management fees are going to be less than 0.2, which is really good. And then your annualized returns are down here. And then, so this is the kind of the risk that we were talking about. So the biggest drop was with the aggressive one, which was negative 31%, whereas if you're very conservative, it's 0.76, and then your returns are all down here, and then so that'll be your performance over a certain time period, and then you would just buy those in these percentage allocations based on where you fall in like the risk tolerance, and then just purchase those and then keep balancing them every year or whatever. Most people just do it at the end of the year just because it's easiest, and then you can kind of get a fresh start going into the new year. So that's the Canadian Couch portfolio. couch potato portfolio, sorry. The other options we're going to go over are Vanguard they have an all-in-one set of funds, which are okay, so there's VGRO, Vanguard All Equities, Vanguard Balanced, Conservative, and then Conservative Income. So these are all going to be split up based on the asset allocation. So there's the fixed income is in the blue, and then the equities is in the orange. And these are just a one-stop shop. So these are phenomenal. Just like these are what I recommend to anybody who like doesn't want to really do too much. And you can just go in and pick which like your risk tolerance is, and then you buy each one of these, like one of them based on your risk tolerance. So the highest risk would be the Vanguard All Equity portfolio, and then the most conservative one would be the Conservative Income portfolio. And these ones don't have too much information on returns and stuff like that, but they're all holding like just all the basic ETFs that we just talked about with really low fees. So these are a great option for people. And then as you kind of get older or closer to retirement, you would switch the funds into the more conservative ones. So you would kind of just go more towards the other end of the spectrum as you get older. So those are a really good option. They also rebalance them for you, and the management fee is somewhere at 0.22. So you're not really paying too much. So these are a really good option. And then like to get the absolute lowest fees, we would just be doing like a one ETF, like the XWD, and then your bond fund. So you would just be buying those in set allocations and then rebalancing them. That would be the absolute lowest fees that you could possibly get. And then in the US, you would just be doing like the S&P or the VTI, and then VXUS or bonds. And then those would be kind of the easiest or like the simplest solutions where you're still going to get pretty good returns out of those. So that's most of the things we covered. The last thing I wanted to go over is just how you're going to go in and buy your ETFs if you choose not to go with Wealthsimple. So it's pretty easy. So we just go in here. So you want to have stock selected here, not options. So obviously you have to open up an account. I'm using Questrade here. Questrade offers free ETF purchases, which is awesome. So you're only getting charged the commission fee on when you sell it, which in a perfect world is going to be in like whatever 30 or 35 years, however long you're going to be working for. And in the US, you guys have stuff like Robinhood, and I'm sure lots of the brokerages offer free ETF purchases. I'm just not familiar enough to comment on that. So super easy. We'll do it pretty easy today. So we'll do the VGRO one. So this would be for your one-stop shop. No, sorry guys, just had some technical difficulties. The ticker wouldn't load. So you're gonna take your total amount of money you're putting in each month. So whatever, we'll say $500. Does $500 sound reasonable? You're gonna have to pull up a calculator. So the price of this ETF is $25.90. So we're gonna divide 500 by 25.90. And we're going to get roughly 19 shares. With ETFs, you can't purchase fractional shares, whereas with some mutual funds, and I think Wealthsimple, you can put in whatever, $100 or $200, and then you can buy fractional units just because the way they're set up, whereas ETFs, you have to buy full units. So what that equals was 19. So we're going to go in here. We're going to put our quantity for 19 shares. If you're purchasing during market hours, you can use market. These are very liquid, most of these. You can just look at what the bid and the ask is. So the ask is going to be which price you're going to pay, and then it'll show up with how many shares are up in the level 1 here. Or you can set a bid if you want to try and get a couple pennies difference, but most of the time it's better just to get your order filled, just in case like the stock or the ETF goes up the next day, then you're going to be paying like 5 or 10 cents more, and then that's going to slowly add up. So usually I would just be more inclined to hit market. If you're outside of trading hours, you can use a limit order. So say you can't get on your computer or whatever, you can put in a limit order. I would generally leave a little bit of breathing room in it. Your broker should try and get the best fill price that they're able to. So we'll say $25.95 for that. And just double check that we have enough money for that. So 25 times 19. Okay, so $4.93. So we can still afford that. And then you're going to hit the buy button, and then that'll put your order through at this. If the market goes up a lot in the next day, you may not get filled if you put in a limit order. So you might just have to put in another one the next night, and then you're going to put either a day, or you can do good till cancel here, which is your order will stay up, and then you can come back and modify it if it doesn't get filled. And then those will show up in your positions in this window. And then when you want to go to sell them, you just click on it, and then the same box will come up, and you just select how many units that you want to sell. So this really isn't that hard as difficult as people will lead you to believe. And then we'll just go through and do some of the other stuff we talked about. So VTI. So there, the price of VTI here. This will be in US dollars. So if you're in the US, that won't matter. If you're in Canada, you're going to have to calculate it yourself with the exchange rate. And then same thing. You can either market order, put in a limit order. And then, I forgot to mention the bonds. So the bonds were ZAG for the bonds. I have this in a document. I'll link it at the end of the video at the bottom. And then the ticker for the US bonds was BND. So if we wanted to buy VTI, we put in our $500, and then you're going to use your asset ratio. So we'll do 20/80 just for today. So we have 500, and then we're going to times that by 0.8, which will give us $400. So we can spend $400 on VTI here. So that's going to get us 2 shares. So we'll buy our 2 shares and hit buy. So that'll give us our 2 units. And then you'll have a bit of extra cash for next year. So then the other one we're going to do is BND. So we're going to buy 20% of BND. So we're going to take our 500 times 2, which is $100. So we'll be able to buy 1 share of BND there. So that would be how you would do it. And then you would just have some extra money left over next month to add into your purchases there. These are pretty expensive just because they're like very popular, and the way they broke up the share structure. So just in the US, whereas Canada, our shares are a little bit cheaper. Okay, so that's pretty much everything I have to go over. If you guys have any questions, just feel free to message me. I'll put this my Google Doc here with the ticker names and all the links into these screens that we went over today, and you guys can look it over. Awesome. All right, thanks guys. Let's make some money.